Let's start by explaining the first scenario, case number A. When the contract is modified, the price of the contract modification for the additional 30 products is an additional $2,850, which means if you divided $2,850 by 30 units, the price will be $95 per unit. So the price is 95. This is the price of the additional unit. Do you remember how much was the original price? The original price was 100. And the new price of the additional unit is 95. Okay, so we have a difference $5 here per one unit. Let's complete. The pricing of the additional products reflected the standalone selling price of the product at the time of the contract modification. So today price, the price that the company is selling their products today is 95. And when we signed the additional contract of 30 units, we sold this unit based on the current price as of today. So this is the standalone selling price. So again, to conclude, these 30 additional units reflect the standalone selling price as of today. So we don't have complications so far. Okay. And the additional products are distinct. What do you mean by distinct? Let's say that you are selling computers, for example. You agreed on 120 computers, and then you signed another contract with the 30 computers. All of these computers are sold and can be consumed, can be utilized, can be used separately. There's no customization. So each one of these computers can be used separately. So these 30 units, as per the case, are separately, not customized, not integrated with the original contract and the original product and services. So here we have the answer for two questions. Let's review the map. The first questions, are these additional goods and services distinct? As per the case, yes, it is distinct, or they are distinct, because there is no customization. Okay? The second question that we need to ask, does the consideration and the price for these additional goods and services reflect their standalone selling price as of today? And as per the case, $95, this is the current selling price as of today in the market. So the answer again for this question is yes. So we have two questions and the answer for is yes. So we don't have any complications. So we are going to follow these new additional product and services. We are going to consider them as a separate contract. We need to account for this additional product and services separately, not related to the original product and services. So let's see how to account for this as a separate contract. Okay. The additional products, how much it was? Actually, it was 30. And how much it was the price? So it was 95. So this is the value of the additional product or the additional contract. Now, let's recognize the revenue for this case as of today. First information that we delivered the first batch of the original contract. The first batch was including 60 units, and the price of these units was 100. So we need to recognize revenue for this first batch, So how many again? 60 units. The price is 100. So we are going to recognize revenue 60 units times 100. So the price will be $6,000. This is in the credit. Now, what is in the debit? Okay. As long as you didn't issue invoice maybe, or there is still some other performance obligations that you have to deliver before issuing the invoice, so we are going to record the debit in the contract assets. And this contract asset represents the money that is still expecting from the customers, but still you have to do something else before asking the customer to pay you or this money. So you didn't issue maybe the invoice yet. So you are going to say this is the same amount debited to the contract assets. And the contract asset in this case will be part of the current assets in the balance sheet. And this is a newly created account or a new created account as per IFRS 15. Okay, clear. This is as per the original contract. How about the additional contract and the additional product and the services? We agreed on 30 units, but only 10 units have been delivered to the customer. 10 units out of the 30 have been delivered to the customer. So we need to recognize revenue for these 10 units. Based on how much price? Based on what price? Based on the $95. Why all of that? Because it is a separate contract. Because the price represents the standalone selling price. Because these additional goods and services are distinct. So this is a separate contract and we don't have any complications in this case. So we are going to record revenue based on 10 units times the 95 times the $95, that is the selling price of these additional units. So the result here will be $950. This is the revenue from the first batch of the additional product and services. And the same will be debited to the contract assets. Okay, this is the first case and we don't have any type of complications here. So far we explained the first part here in this process map. We explained the first part here, which is the answer for these two questions is yes, we don't have any complications related to distinct performance obligations. The performance obligations are distinct and the price represent the standalone selling price. So this is a separate performance obligations. So this is the first case that we have. In the second case, we are going to introduce the complications here that we have. So we are going to say, how can we deal with catch-up adjustments? And how can we terminate the old contract and initiate a new contract if this complication is related to the performance obligations are not sold on standalone selling prices? Let's see.